When a company borrows money from a lender, the lender will give cash to the company. At the same time, the company will have a liability called notes payable. So the accounting record will record the cash they receive from the lender at the date of issuance of the note as note payable. Note payable represents the principal of the debt. Sometime later, when the note expires, or we call it when the note matures, meaning the end of the note, the end of the period, lender is willing to lend out the money to the company. At that date, at the date of maturity, the company will pay back the money they owe lender plus interest, because several days or months after lending money to you, there is a cost of that much of money. The cost of money of the time is called interest. So at the date of maturity of the note, we need to pay back lender principal plus interest. And usually in finance, we call the amount of money paid back to lender as future value. And the amount of money we receive from the lender is called present value. So how do we calculate present value and future value? So for this example, the amount of money I receive today, assuming to be January 1st, 2019, and the amount of money I need to pay back to lender is called future value, including principal plus interest. So how do I calculate future value? If I borrow $20 today, and if the interest rate the lender charges me is 6%, then let's start from 1 year later. Today, January 1st, I borrowed $20. If I need to pay him back 1 year later, 12/31/2019, then the future value of that $20 on December 31st, 2019 will be calculated by $20 of principal plus interest. Interest of that $20 is interest rate. Interest rate, if assuming to be 6%, then it will be rewritten as 1 plus 6%, right? 20 for the first components, 20 for the second component, pulling them out, 20 here, and then the parentheses has 1 plus 6%. So the $20 multiplied by 1.06. 1 year later, if I need to pay the lender back on December 31st, 2019, the future value of that $20 is $21.20. Okay, how about if I am going to pay him back at the end of the second year? So I will pay him not only the principal I originally borrowed, I also need to pay him 2 years of interest. Well, as of December 31st, 2019, the end of last year, we are standing here now, 2020, but last year, totally, if I didn't pay him back, I owe him $21.20, including the original principal and the first year of interest. So this should be paid, but I haven't paid him. Instead, I waited another year. So I will calculate interest based on this $21.20 I owed him. Okay, so the $20 of original principal plus $21.20 multiplied by 6% of interest rate. And you can separate the second component as $20 plus the $1.2 is original $20 multiplied by 6% rate, right? Okay, so first 20 is this one, and then the $21.20, I separate them into $20 plus 1.2 cents, $1.02, $1.2, which is the interest from first year. So the second component, $21.20, will accumulate one more year of interest. So this $21.20 will multiply by another year of interest. Then do you see I can rewrite this formula into $20 multiplied by 1 plus interest rate and power of 2. So what's the future value of the third year? So if I didn't return money at the end of the second year, this amount of money will continue to accumulate interest for another year. So the third year, when I pay back the lender, I will totally pay back him 20 multiplied by 1 plus interest rate, power of 3. And this 1 plus 6%, 1 plus interest rate, power of n periods, is called discounting factor. So when we want to look for discounting factor in a table which is online or at the end of your textbook, we can find it here. So go to your textbook, roll all the way down to Appendix B, time value of money, and then roll to tables. So here we have present value of $1, future value of $1. We are calculating future value now for this $20 3 years later. So you will take the interest rate, look at the table. Interest rate is by columns, and periods, number of years, is by rows. So for 6% of interest rate, after 3 years, the discounting factor is 1.1910. So you can rewrite this calculation as $20 multiplied by future value discounting factor 3 years, 6%, 1.1910. So 3 years later, I will return money to the lender, principal plus interest of $23.82. Whereas the present value, if I will return money back to lender for $20 3 years later, how much he is willing to lend me today. So look back to how we calculate future value. It is by multiplication. From here, multiply by 1 plus interest rate for periods of time in the power. And if we want to find the present value of a future amount, we use division. So present value of that $20 in the future is calculated by 20 divided by 1 plus interest rate and the power of 1 to 3 years. if we continue to use 6% of interest rate, we can rewrite the formula as this way. Okay, 20 multiplied by a division, 1 over 1 plus 6% power of 3. Again, this can be found in the table. You don't need to calculate by yourself, or if you are using financial calculator, they will give this discounting factor to you. So if we want to look up the discounting factor of 1 over 1 plus interest rate over period of 3, so we go back to the textbook. At the end of the textbook, we look for present value table, present value of one single amount, 6% for 3 years. The discounting factor is 0.8396. So we will use $20 multiplied by 0.8396. 96 or 6996. Okay. Therefore, the $20 in the future is worth $16.79 now. So that's how we calculate present and future value of one single amount.